Welcome back, RMJ. Ready to pick up where we left off with Poach and Steele?
Mhm.
We were just about to get into the nitty-gritty of consolidating those financial statements. I've laid out the roadmap here on the board. Since we're tackling your homework, do you want to march through it step by step from the top? Or is there a specific part like the PERP or the NCI that's giving you a headache? You got it. Step by step is the best way to make sure nothing slips through the cracks. First thing we always do is map out the group structure so we know who owns what. Say Poach acquired 60% of Steele. Since total ownership is always 100%, that leaves 40% for the non-controlling interest, or the NCI. That's the part of the company owned by outsiders. Now, here's a huge clue from your materials. It says Poach bought Steele on its incorporation. In accounting speak, that means they've been there since day one. Because they started the company themselves, there was no extra cost over the net assets, so we don't have to worry about calculating goodwill. It's zero. Does that at incorporation part make sense before we move to the math? Great question. Here is the big clue. You only calculate goodwill when one company buys an existing company. Think of it like this. In your homework, Poach was there for the birth of Steele. Since they didn't have to pay an extra premium to buy out a previous owner, there's no goodwill to put on the board. Make sense? All right, next up is the pup. It sounds like a puppy, but it's actually about fake profits. Note 2 in your materials says Steele sells goods to Poach at a 25% profit margin. Basically, Steele sold goods to Poach and made $3,000 in profit. But because Poach hasn't sold those goods to an outsider yet, the group hasn't actually made that money. It's just sitting in the warehouse. We subtract this $3,000 from the inventory and also from the seller's profits, which is Steele in this case. Since Steele is the seller, does it make sense why we take that profit away from their total earnings? Great catch. Always track the numbers back to the source. That 12,000 is straight from note 2 in your materials. It's the value of the internal goods still sitting in Poach's warehouse at the end of the year. If Poach had sold them all to customers outside the group, the pup would be zero. But since that 12,000 is still there, we have to strip out the profit hidden inside it. Cool? Now we need to figure out the total bank account for the group, known as consolidated retained earnings. We start with Poach's full amount and then add their piece of Steele's profit. Wait, you see that 70 for Steele? Let me show you exactly where that came from. We take Steele's profit from their own column and subtract the pup we just calculated. That 73 is from the retained earnings row for Steele in your activity table. We subtract the 3,000 pup because Steele was the seller. Then, Poach only gets 60% of that remaining 70, which is 42. Add that 42 to Poach's original 147, and you get 189. Do you see how we only give Poach 60% of Steel's adjusted profit? Got it. I will make sure every step has a clear equation right above the numbers so you can see the logic. Let's formalize that retained earnings step first. Here is the math in action using the numbers from your notes. Now, let's tackle step 4, the non-controlling interest, or NCI. This is the 40% of the company that Poach doesn't own. Let's plug in the numbers. Your note 1 says the fair value of NCI at acquisition was $4,000. See how we use the same adjusted profit of 70 for both? The group gets 60% and the NCI gets 40%. Does the way we split that 70,000 between Poach and the NCI make sense? No sweat. Let's break it down like a pizza. Steel is like a subunit. They made 70,000 in real profit because Poach owns most of it. 42,000 goes to Poach's pile. The rest of the owners, the NCI, get their 28,000. That is why we use those percentages. Poach's 42 gets added to their own 147, and the NCI's 28 gets added to their starting 4. Does that make the why behind the percentages a little clearer? Last big step. We combine the numbers from Poach and Steel line by line. But there's a trick. We have to cancel out any money they owe each other. Your table shows a receivable of 30 and a payable of 30. Here's the equation for the combined inventories, which is the only one with a hidden twist. The 22 and 18 are from the first table in your notes, and we subtract the 3 from our PUP calculation. Now, let's look at the receivables equation. See how we added everyone's receivables together and then yanked out that 30? It's like moving money from your left pocket to your right pocket. For the whole person, nothing actually changed. Ready to see the final finished statement? Good eyes. Let's clear that up. I grabbed those numbers directly from the current assets section of the Steel column in your homework table. See that blue 29? That is labeled as receivables other for Steel. That's money people outside the group owe them. And the 30? That's the intra-group balance. It's listed as receivables from Poach under the Steel column. This means Steel is waiting for Poach to pay them $30,000. But when we look at the group as a whole, that $30,000 is just moving internally. We subtract it because it's not money coming into the group from the outside world. If you look at the payables for Poach, you'll see a matching $30,000 to Steel that we also cancel. Does that clarify where the 29 and 30 came from? Perfect. You've powered through the whole process, from the group structure to the pup, and then the final consolidation. Let's wrap this up with a quick summary and some flashcards to keep it locked in. We've checked all the boxes on your homework. Do you feel confident about how we got those final numbers? Whoops, you're totally right. I showed you the ingredients, but I didn't bake the cake yet. Let's pull it all together into the final consolidated statement of financial position right now. Check it out. We combined PPE and cash normally. For inventories, we subtracted that 3,000 PUP. For receivables and liabilities, we canceled out that 30,000 internal debt. And look at that bottom line. 431 on both sides. Perfect balance. Does seeing it all in one table help bring it together? Boom! Glad that clicked. Consolidation is all about that final balance. Since we've crushed the math and the layout, you are officially ready to turn this in. Is there anything else on this problem or your notes that feels a bit fuzzy? Or are you feeling like an accounting pro now?